This is a monthly series that we have for business owners. We call it Charting Opportunities. Thrilled to have another special guest today, Brandon Davis. Brandon's the president of the Carolinas in here for National Christian Foundation. And he's going to take some time to talk about philanthropy. Not only the benefits of giving, which are obvious, but there are other taxable benefits, and if you plan an exit from a business the right way, there can be a lot of additional benefits other than just who you're doing to. So
donors or givers that were most structured and able to really serve from a high value standpoint are business owners, landowners, real estate owners, people that have these kind of assets on their balance sheet. When you give appreciated marketable security like that, stock in Piedmont Natural Gas in this example, the value, you get the full value of the deduction. When given a charity, you receive the full value, market value of the deduction as a tax write-off, as a tax deduction. So the charity will issue a receipt to you that'll essentially have the value in it, or there's specific rules how to calculate the value. Donor advised fund, sometimes we'll call it like a charitable checking account. So if you're familiar with this, forgive the review, but just to kind of make sure we're all on the same page here. Donor advised fund, kind of like a charitable checking account. In the simplest of terms, the donor advised fund sponsor, NCF, is a 501c3 nonprofit charitable entity. You give cash. It's simple. You give cash. You write a check to National Christian Foundation to your donor advised fund. You'd have a name on the fund. We'll put a number on the fund, kind of like a checking account. You make instead of a deposit, you make a gift, charitable gift, into the donor advised fund. We issue you the tax receipt. We're the charity. We give you the tax receipt. Now, money has now been irrevocably given to charity. It's sitting in an account called a donor advised fund, and then you have, as the fund holder, we would call it, you have advisory rights over the donor advised fund. So again, building on the concept of, you've got a donor advised fund that can hold money, issue the receipt, make grants out to charity. How can you fund that donor advised fund? Cash, write a check, great. But we would say all day long, if you've got appreciated assets in your portfolio, fund your donor advised fund with that.
At what valuation does it make sense to do something like this?
Yeah, good question, common question. We would say, just kind of economically speaking, particularly with a privately held business, minimum threshold of a gift would be about $300,000 to $500,000 would be kind of minimum threshold. There's no magic to that other than to say, by the time you've gone through the steps, I mean, they call these complex assets for a reason, right? It's a logical process. The steps in the process are clear and line up, but there's just a little bit of time and complexity associated with it. And so in an ideal setting, the company would already have voting and non-voting shares, or again, if the conversation's had early enough in the planning stages, it can actually be accomplished where that can be recapitalized into voting and non-voting. And so the charity would therefore own non-voting shares, which means economic interest, but not operating interest. There's other elements we have to navigate, we can get into, but that's a common solution and a desired structure from our standpoint. So it's very good.